I'm Joya Das for TheStreet.com, and we are talking about gold today. It is at its lowest level since August 2010. And Keith, of course, it's no big surprise that the Fed has something to do with this, but why should we care?
Well, you want to care about what's happening in the price of gold because it reflects a bunch of different economic and fundamentals and metrics that we look at and then relate that back to the equity market. So gold is selling off not only because of the Fed's actions and what they're saying about the U.S. economy, but as a result of the Fed's actions, the dollar is rallying. Of course, any commodity that's priced in dollars, if the dollar depreciates, it's going to rise on its own. If the dollar appreciates, then that's going to fall. So that's having a big impact. But what's happening with the price of gold right now is gold really rallied in 2010 and 2011 as a store of value to be that hedge against inflation. We're just not seeing inflationary pressures inside of the U.S. economy or the globe in general, and that's why people are pulling out of it. It's the trade. It was basically dead money for a while, so people are getting out of that and getting into something higher yielding.
Do you see gold going below $1,000?
Not at this point in time. That would be a little too soon. We tend, in the work that I do on a quantitative and a technical level, we keep our time frames fairly short. I suppose gold could get there if we continue to have this deflationary pulse throughout the globe, which is what we've really got. If the Chinese economy continues to swoon a bit, if the Indian economy does not dig out of its hole, if the European economy doesn't, and if the U.S. economy starts to stall a little bit, and we've seen, again, there's no inflationary pressure from the Fed's actions, then it could get below $1,000. I think short term, though, we're looking at a price of around $1,210 for that to be short-term oversold inside of our work. You get there, we'll probably get a trade back up to $1,300. Like any market, anything that we trade, there's always a reversion to mean possibility, and that's what we see in gold right now. It is getting oversold, but it's not quite there yet. I'd still wait a little bit.
I read that India might be curbing imports of gold, and them being the largest consumer of the commodity. Any thoughts on that?
Not really. I mean, they're probably looking to place their money in other places, maybe infrastructure spending and other things that will actually help the economy as opposed to being a harbor for gold right now. The central banks have been, it's been well known that the central banks have been buying gold again as a store of value, probably hedging against their own policies for quite some time. And they're like every other investor. Once they sense that perhaps it's not needed anymore, they'll take their money and they'll place it elsewhere. As I always say, capital goes where capital is rewarded, and right now it's not in gold.
There you have it. That's Keith Bliss from Catone & Company, and I'm Joya Das for TheStreet.com.